Ladies and gentlemen, welcome back to the channel. Here in this video, we're going to get into everything you need to know currently on AMC Stock. But I also just want to discuss where I think we're going. Obviously, in our markets, it doesn't care about what happened, right? You shouldn't care about what has already happened. You should care about what's coming next. And I think for the first time in quite a while, we have a little bit of clarity on our markets. Now, I'm not a fortune teller. I'm not a financial advisor. I'm not a financial planner. I don't have a crystal ball, okay? But it seems pretty obvious what's coming for the markets next. So I want to go ahead and get into that here in this video. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Let's not waste your time and let's jump into it. So it is pretty obvious what's coming next for our markets. We have gotten a lot of clarity. We just got a lot of economic data that came out. We just got the Fed. We just got through earnings season. And that set us up in an interesting way. Small cap stocks have started to do well. And I think that's going to continue for a while. Now, there's one big thing that really matters right now. It's the Fed and the market's expectations of Fed policy. We have heard from one Fed speaker since the Fed meeting. And since the Fed meeting itself, we have seen long duration yields basically plummeting, basically falling off a cliff. Your 10-year Treasury yields are at 4.577%. You were just at about 5%. So you have seen about 2 rate cuts on your 10-year Treasury yields, roughly, right? Now, we just heard from Fed Bostic, and what he said is pretty dang shocking. Fed Bostic sees inflation falling back down to the 2% target in the second half of next year. Now, that's shocking in and of itself, because if you look at the summary of economic projections, what we got in September, the Fed itself does not think inflation's falling to 2% till 2026. So Fed Bostic is way ahead of your average Fed member. Core PCE inflation, according to the Fed, is only going to be around 2.6% for next year. So if that happens, then obviously you're looking at some very big rate cuts that will be coming. Now, Fed Bostic made a couple interesting statements here as well that I think you really need to know. And this was a Bloomberg television interview. He was asked how long will it take to get inflation down to that 2% rate. Bostic said, I would say it's going to be in the second half of next year. He said a lot can happen over that time period, and he would not attempt to be more precise. And again, I think it's important to point out that PCE, again, right now is 3.4% on the headline and 3.7% on the core. So you're still quite a bit off of that as of right now. Fed Bostic says we're going to be in a sort of slow, steady growth that is methodical in 2024. Asked when the Fed would cut interest rates, Bostic said, that's down the road. This is the biggest bombshell that he actually said. He said that the Fed would mull when it was best to cut rates as inflation gets closer to 2%, adding, quote, we cannot wait until we are at exactly 2% to start reducing rates. It has got to be before that. You're at a headline PCE of 3.4%. You are at a core PCE of 3.7%. If these things start to fall in any kind of meaningful way, we're going to be looking at some rate cuts. If the data starts to look down for our economy, you're going to start seeing rate cuts. Let's be honest here. The Fed is not technically a part of the government. They have no government stature at all. They're a separate entity, basically a private entity at that. But they are elected by the government. The literal president elects the Fed chair. or reinstates the Fed chair, in which that happened with Fed Jerome Powell. Heading into an election year, the worst, and I mean the worst thing that can happen is an economic downturn if you're trying to get reelected as a president. That's not political. That's statistical. There's only been one president ever that has won a reelection within 2 years of a recession happening before an election. So technically, if you wanted to say we had a recession during even 2022, which I think all of us would basically agree to that, right? You had 2 negative quarters of GDP. I personally think we've probably been in a recession ever since then. It's my personal opinion. There's wonky ways people kind of calculate GDP, inventories, all kinds of different things go into the mix when it comes down to the GDP report. I would argue we've kind of been in a recession for a while now. Stocks have been in a recession. That's for sure. Like 90% of the markets have not done well in the last 2 years or so. And I would argue just the cost of living alone has a lot of people feeling a lot just worse about the situation. If we didn't have credit cards, if credit cards were non-existent, the situation would look way different than it does today. People are spending money, but they're spending money on those credit cards. So, there's going to be a lot of pressure to accommodate the economy heading throughout the rest of this year. Now, that will be bullish for stocks. But I will say, when the economic data starts to turn more downwards, you kind of seen that on Friday a little bit. Your non-farm payroll report came in at 150,000 jobs. I was very clear about this. If you come in at like 100,000 jobs or less, markets are not going to look at that as a positive thing. They're going to look at that and say, holy recession, what in the world is coming? You were expecting 180,000 job ads. So the first time, and it seems like a long time, the jobs report actually came in 30,000 jobs light. Lower than expectations. The unemployment rate went from 3.8% to 3.9%. You're starting to see a little bit of cracking in the labor market. That's just gonna, crack the economy essentially. ISM Services PMI came in at 51.8. You were expecting 53. So some good news here. I mean, a little bit lighter than expectations, but it's really a slippery slope. Right? Once you start to get a downturn in the economy, it can go pretty quickly. If you look at basically any data, you'll see that. Heading into your recessions, besides the Rona, you tend to see an uptick in these things until they just pretty much go vertical. So the markets can handle bad news. They cannot handle uncertainty. When that data starts to turn down, when the Fed does actually cut rates, the markets are going to be hit with a lot of uncertainty on where the economy is going, and they're not going to like it right off the bat. That will happen at some point, probably towards the end of this year, if not in the first 3 months of 2024. And that uncertainty will take over until we have more clarity on the economy. That is a simple fact to me. But here in the near term, as we just got some okay economic data, a little bit weaker than expectations, but not showing an utter collapse. We just got through earnings, which, I mean, they were pretty good, all things considered. We just got through the Fed. Seems like the Fed's going to be a little bit more accommodative, a little bit easier on policy. I think tactically you have to be bullish. From now until the end of this year, or whenever the economic data starts to really turn downwards, if that is the case, you have to be bullish right here. The Fed basically gave you a green light with that Fed bombshell and the Fed meeting that we just got just being so dovish. The Fed literally said that Treasury yields, the US dollar staying elevated, and stock prices could dictate Fed policy. The Fed a year ago would not have even mentioned stocks, the dollar, long duration yields as a factor in Fed policy at all. They wouldn't have. That's because they're really getting to the end of their cycle here. And I think it's pretty clear if you take out housing in this equation, you've basically conquered inflation. And it looks like ISM services are falling like a rock. So it looks like inflation is pretty well conquered. The problem is just prices have been high for so long. You probably need to see a recession to see some reset in those prices. So from my opinion, tactically bullish from now until the economic data starts to turn down. Probably during the holiday season, those shopping numbers are probably going to be pretty discouraging. That would be my estimate of kind of you know, when you want to be tactically bullish. And then in 2024, I do think the first rate cuts is probably not going to be a bullish thing for our markets. It's probably going to be one of those situations of uncertainty. Think about 2022. If none of that made sense, think about 2022. Why did the markets freak out? Why did the markets fall like 35% on the NASDAQ? A little bit more than that, I believe. Well, it was because not the Fed was raising rates. It was because the Fed was raising rates, and that pushes you into recessions more times than not. That's it. That's the bottom line to it. So when that recession fear comes up again, don't expect that to be bullish. Something else I do think is very bullish for AMC, for really the broader markets themselves. Take a look at the M1 money supply. So the M1 money supply was about $4 trillion in December of 2019. This is all the money out there. Physical currency in bank accounts, all of that, just all of the money in the US. You went from 4 trillion to 20 trillion. No wonder you've seen inflation. Now you're down to about $18 trillion. But this chart is of money in money market funds. This blue line has went crazy. It's at about $6 trillion. Now, normally you peak out during a recession or right before, and then you can see a pretty dramatic pullback. Usually following a recession, coming out of a recession, you on average see like a 25 to 40% pullback in the amount of money that is in these money market funds. Now, this time around, the money market funds are, you know, doing so well at almost $6 trillion because rates are so high. Now, this is about $6 trillion compared to $18 trillion that is out there. If you look at even 2022, you had about $5 trillion in money market funds. So you've increased about $1 trillion. If you look at pre-pandemic numbers, you were at Q4 2019 at about $4 trillion. So you've increased basically $2 trillion since the Rona. I want to just ask you guys, really, ever since 2020, there's been a lot of fears out there. There was fears about a recession. There was fears about a second wave of Rona really shutting down the economy, being worse than the first one. And there's been recession fears ever since then. And rates have been 5.5%, 5% for a while now. You've been able to get 5% in a money market fund for quite a decent amount of time. Investors are just sitting here. Now, when Fed funds rates do come down, when we have more clarity on the economy, maybe when we get a reset in the economy, a little bit of a recession, a lot of this money is flowing back into the markets. And this is like your liquidity, right? Your liquidity has been drained out of this market. When that flows back into stocks, I would imagine, are going to do very, very well. So a couple different things that I wanted to highlight here in this video. I think at some point in 2024, this will happen. And I think money market funds will start to see money, go away. And even if we were to go back to where we were in Q2 of 2022 at about $5 trillion, let's call it add $1 trillion back into our markets. I mean, that's going to be a big deal. And think about it like this too. Money market funds are $6 trillion. All of the money in the US is about $18.5 trillion. But money market funds is different than money just circulating out there or in people's bank accounts. What percentage of this $18 or so trillion, $18.5 trillion, do you think makes it into the markets? Well, you guys, right? You probably invest about 10% of what you make, maybe 20%, 30% if you're lucky. You should always pay yourself first. Save 10%, pay yourself first. That's literally in the Bible. But people don't do that, right? I would argue 5% or less of that $18 trillion is going to make its way into our markets. Now, this money market fund money is already in the markets. It's just in money market funds. So what's 5% of $18 trillion? Or just simple math here. What's 5% of $20 trillion, $1 trillion, right? Okay. Now, what's $1 trillion divided by 6 trillion, right? That's going to give you around 20%. So you could see 20% outflows to money market funds. That would be equivalent to about 5%, give or take, right? Rough math. About 5% of all of the money heading into stocks that is out there circulating. That would be a very big deal for our markets, for everything, essentially. It would be a situation where, a rising tide lifts all boats. With trillions of dollars that will head back into our markets at some point in 2024, you got to be bullish on that. You can't be bearish on that. Maybe they stay in this money market fund for a while. It really depends on the course of, Fed rates. Jeffrey Gundlach believes once a recession comes, you're probably going to see 2% of rate cuts. And I do agree with that, right? If the neutral rate being you're not restrictive nor accommodative on the economy, is Fed funds rates minus PCE. Well, what's the neutral rate of where rates need to be? You call Fed funds rates at 5.5% minus, call it 3.7%. 1.8% would be roughly your neutral rate at about 2%, give or take. So yeah, I think there's room for a lot of I guess that would technically be 1.8% of rate cuts. So you could get a 2% rate cut and be basically at neutral now because inflation has fallen so much. So that's something I am looking at here, and I think you guys should also be looking at as investors in our markets. So that's going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with us live in real time, come get access to all of the notifications, trades that I make. I'm not a financial advisor. That's not financial advice. Come learn, come grow, come trade, whatever. Link down below in the description of this video. You guys have a great rest of your day, and I'll see you in the next one.